Here I am basically trying to explain the difference between limited risk and unlimited risk in a transaction of options, particularly when you are following a strategy. Here I have taken the closing price of Nifty 50 on Friday, the 12th March 2021. And the next opening day of Nifty is, as you see over here, 15th March 2021. Market has not yet opened. Let us assume that on that day, one trader or one operator tried to take some position exactly on the end of the day. That means these prices which are included here will prevail for him. Now let us put it into a chart. Let us suppose he has sold one call and he has sold one put. The market that day, the underlying price was 15030.95, which you can see over here. And now with that underlying price in mind, he took a call, he actually sold a call at a strike price of 15,200 and sold a put at 15,000. As you see, 15,200 is more than 1503.95 and 15,000 is less than 1503.95. But very close. I mean, these two positions are very close to the underlying price. He did this with this premium. Call he sold at 82 rupees because that was the premium prevailing in the market, and put he sold at 146. This was actually the premium prevailing in the market. Here the green ones, you can see this one and this one. So these were his position. This position is called strangle. That means he is strangling the underlying position from two sides. From the call side, this one, and from the put side, this one. If he takes this position, then his profit will be like this. This green area will be his profit and this red area will be his loss. So if the price, that is the underlying price, prevails between 14,800 to 15,400, he will be profitable. That also you can see here, 14,800, 15,400. He will be profitable. And his profit will be of different dimensions. It could be 2,100, 5,850, going up to 13,350 or 17,100. This is the top here. And again it can come down to 2,100 if the price, the underlying price goes towards 15,400. But if the underlying price moves away, say at 13,700 or 16,600, then he will have this much of loss. In fact, this curve shows that his loss is unlimited. That means if the prices goes beyond this chart, that means 13,000 as against 13,700, if his price is 13,500 or against 16,400, suppose it becomes 16,800, then the losses will be further higher. That is why whenever you see this kind of decline on the red side, you can always assume that the losses are unlimited. Here he could have made a maximum profit of 170,100, and within this range, within the range of this chart, he would have a maximum loss of 87,900, which is here and also here at the bottom. But as I said, if the underlying price moves even beyond 13,600 here, or 16,600 here, then the losses can go even further. Now he is little worried because the market volatility is not liked by him, let us say, and then he wants to limit these losses. To limit these losses, he can buy 2 more positions. This time he has to buy. He bought a call at 15,300 strike price and a put at 14,900 strike price. 14,300 is above 15,200 and 14,900 is below 15,000. And he paid these costs. These are the option premiums. These I have taken directly from the published data. Now, what will be his situation? His situation will be like this. He will have a maximum profit of 4,998.75, but his maximum loss is limited to 2,501.25. That means in this case he is well protected. In fact, after taking this position, he can sleep peacefully, I should say. Although it may so happen that you have to adjust this position later on until the expiry day, but still you are within a very limited profit and limited loss. This type of position is known as iron condor. People with limited resources very often takes iron condor. If we take iron condor properly, then you can work within a limited range of loss and profit. I mean, this is obvious. When you are reducing the risk, your reward also will automatically reduce, and that is a global phenomenon. So in this you have understood 2 strategies, and you have also understood why one of the strategy has unlimited risk and the other strategy has limited risk. Thanks for your attention.